The stock market is very volatile a day after Bernanke's speech saying that the Fed could begin to start scaling back on QE sometime soon. Joining me today is Keith Bliss from Cuttone Co. Keith, thank you again for joining me.
It's my pleasure.
Absolutely. So how surprising was Bernanke's speech yesterday for you?
His speech wasn't at all surprising to me. What was surprising is the market's reaction. I think they were just looking for any excuse at all to take it down. The market's really been on a knife's edge and really indecisive over the last 2 weeks. You could have teased anything out of Bernanke's comments yesterday that you wanted, either the bull or the bear case. I mean, one of the things that I took away, one of the things that was so surprising to me about the sell-off is his comments were not all that hawkish to me, because he talked about economic data improving, being better than it was 6 months ago, but it had to be at certain levels before they really started paring back. And the Fed is notoriously bad at economic forecasting, when they talk about unemployment rates and other things like that in GDP. So I didn't take it I thought it was pretty benign comments, so I was really shocked when rates shot up and then the market sold off as a result.
It seems as though his comments were very similar to his comments from the last few statements. So why do you think today we are seeing the Dow drop over 200 points? Why do you think that is?
Well, again, I think there's a trade-on right now, or trade-off, if you will, depending upon your perspective, and they're just now gauging what that's going to be. And I think there's a lot of there's a lot of people that are thinking that there's credibility in what he says about paring back. The other issue that I've heard from people is, despite what the economic forecasts are going to be, or despite what the economic data is going to be rather in the next few months, is that they truly believe that the Fed will start paring back on their bond buying, because the efficacy of the program has pretty much reached its finality in that, and that we're not getting very much movement in upward economic activity, no matter how much money they throw at the problem. So that's what a lot of people are also thinking. They're taking a bit of a flyer in their bets inside of this market right now and saying, well, the Fed's going to pull back anyway because they have to go to plan B, whatever that is, or plan C or D at this point. So that's the other pressure that you're seeing here. The other thing that you're seeing inside of the market today is, interestingly enough, I used to not give too much attention to weekly jobless claims, but there is a very high correlation between market movements and weekly jobless claims. You could lay the charts on top of one another. When jobless claims go up, the market sells off pretty dramatically, and then you've got weak China data. Bernanke, weak China data, worse than expected weekly jobless claims. We've got a nice sell-off going here today.
Also speaking about that Chinese PMI data that was even more grim than the May report. And then in Europe, you have the PMI kind of edged up, but still it's below that contraction level. And then in the US, really unchanged. How concerning is that for the manufacturing sector?
We were told that we were going to have a manufacturing renaissance, and it's the manufacturing non-renaissance is what's happening. I mean, it's just not occurred, and quite frankly, that's not surprising when you think about the lack of capital investment during this pretty much moribund recovery that we've been going through the last 4 years. The manufacturing sector is the one that's going to lag everybody else. We'll see pickup in technology and some other service sectors, consumer non-discretionary, and so on and so forth. So the bigger problem that you have is that manufacturing, it's been diminished somewhat in our overall economy here in the U.S., but globally it is still a major portion of it, and China is trying dramatically to move their economy from one of manufacturing and exports to consumption, imports, and a little debt, not as much debt as they have. So they're going to go through some pain transitioning that way. But the China PMI number is troubling, not only from the headline number, but what's underneath it. There's pretty dramatic drawdowns in their inventories, which means the factories are not firing up and rebuilding the inventory, and the export number was down. So they're going to start seeing that pain, and that will have a direct impact on their GDP, which will be a problem for global markets if they come in weaker on that level.
Now, other data today showed that existing home sales actually rose to their highest pace since November 2009. Is this something, well, obviously that is optimistic, but do we need to continue to see that kind of pattern for a long term here?
Besides the wealth effect, the housing recovery has been marvelously engineered by the Fed's monetary policy. You have to say that. I mean, we're at that point where we can make that call. One of the reasons that you have existing home sales continuing to blow out is that anybody who was thinking about buying a house is now jumping in and buying the house as rates start to tick up. If you had your eye on a house and you were thinking about making a move, you got to go do it now if you think this rate march forward is going to continue. The one thing that I want to look at, I didn't have a chance to before we talked, was what is the transition of people? Where are they moving around the country? Do we have that kind of movement which will signify that we have a healthy economy? If people are able to move to different regions and pick up jobs, is there job growth in one region and people are moving, then that's a very good sign. My sense is that it's basically just people moving from one side of town to the other, right? They've had their eye on a house, they're able to get it on the cheap. That will come to an end at some point as rates go up and the home prices start to moderate. But right now, we'll take it as good news. It's not enough to offset what's going on inside this market right now, though.
And finally, the FOMC is going to have a meeting in July and then in September, but it seems as though from a lot of the traders I talked to down here on the floor, they think September is going to be kind of that bigger meeting where we may actually hear something new from Bernanke. Do you think that's the case?
I do. It's interesting, the calendar that they laid out for this year, those meetings run so closely together. In the July meeting, we're not going to get a whole lot of really market-moving economic data. We'll have the usual stuff on a month-to-month basis, but not a lot of moving economic data in that time period between this week and the end of July. So September is going to be the real key meeting. I think the language that will come out of the July meeting will almost be identical to what we heard yesterday. You could probably lay the two statements on top of each other, and they'll be the exact same words. So in September, when we get that, get ready for another bumpy ride. As I've told everybody, listen, we have to come out of this bond buying program at some point. People forget in 2009, 2010, when they were laying in the QE programs, the ride into those things was very bumpy. The markets were very volatile. It's going to be bumpy going in. It's absolutely going to be bumpy coming out, and that's what we're seeing right now.